What's up, everybody? On this channel, I have talked about nearly every major position that I hold in my portfolio. If you go through my videos, you'll hear me give my thesis on plenty of companies that I'm bullish on. There's really only one group of companies that I own that I haven't ever talked directly about on this channel. It's a sector that I think it's looking like deep value today. There are plenty of companies in this sector that are trading for absolutely dirt cheap valuations. This one here is trading for just 2 times forward earnings, a little over 3 times forward free cash flow. And it's not even the only company I could have picked with metrics like this. This is just a sector that has sold off massively over the past few years. I think there's a number of companies here that are presenting deep value opportunities today. But as with many opportunities like this, there is a reason why it's cheap. There are plenty of people who absolutely hate this sector. I'm sure once I tell you what it is, maybe some of you have already guessed. But I'm sure when you find out, there will be some people out there who will just say, I'm not interested, and that's okay. But today, we have to talk about oil and gas companies. As always, if you get value out of the video, subscribe to the channel. We recently passed 2,300 subscribers here, so thank you so much to everyone who has followed. And for everyone who's asked where they can get my Google Sheets, I will be starting a Patreon soon. I will have all my sheets, my watch list up there. It's going to take me a little bit of time to get that set up, maybe a month. I want to make sure that I have some content for there, that I'm giving you guys good value. Now, let's jump into oil companies. And specifically today, we're going to be focusing on upstream oil producers. Companies that are pulling oil out of the ground, those are the upstream companies. If you're a company that's dealing with the transportation of oil, maybe it's a pipeline, those are midstream companies. And then if you're a company that's involved in the refining of oil, for example, so let's say you get oil, it comes to you from a pipeline, it's crude oil, and you have to refine that into jet fuel and diesel and gasoline and all the products that we use in the everyday world. Companies that are involved in that refining and distribution stage, those are downstream companies. Now you have some big players like maybe ExxonMobil is the best example that's really involved in every area of the oil industry. But a lot of the smaller companies can probably mainly be categorized as either upstream producers or, mainly in one area. I just want to highlight really quick how cheap some of these small upstream producers have become. These charts here are from a presentation from Berry Corporation, which is a small American upstream producer, and they say they have a 28% free cash flow yield. Many of their peers are also in the 20s, and a lot of these small producers, they have double-digit free cash flow yields. In terms of enterprise value to EBITDA, which is a very common metric used for analyzing these companies, because a lot of these companies have different levels of debt. So using enterprise value, remember enterprise value is different from market cap. Market cap is the value of all the outstanding equity of the company. But enterprise value, that's how much you would have to pay if you wanted to buy out not just all the equity, but also pay off all the debt. If you just wanted to take over the whole enterprise debt-free, you buy out the equity, you pay off the debt, and then if there's any cash sitting around in the business, you get to put that in your pocket. So the net cost to you is the value of the equity, the market cap, plus the debt, minus the cash on hand. And if you compare that number to EBITDA, earnings before interest, taxes, depreciation, and amortization, you get that Berry's trading for a 2.7 times multiple. Many of their peers are trading for, 2 to 4 times multiples. This is absurdly cheap. Now, companies like these have never traded for expensive multiples, of course. There are real risks for an oil producer. We'll talk about some of them. The most obvious one is that your revenue is tied to oil prices. But still, historically, upstream producers like this have traded more like, 5, 6, 7 times multiple of EV to EBITDA. For a whole bunch of these companies, their valuations have just gotten almost silly since April of this year. Vital Energy, which I'll use maybe as an example here, they are down more than 50% on the year. April, they sold off a massive amount, dropping about, 30, 40%. The market, it seems, is basically pricing in the end of oil. A similar thing happened about 5 years ago during COVID. Obviously, COVID was a massive shock to oil demand. Oil prices tanked. This massive drop in oil prices, that's COVID here. But what almost always happens for a commodity, it's called a cyclical industry for a reason. Low prices leads to producers not wanting to invest in the space because why would you want to invest? Prices are low. And then that leads to lower supply. And then when supply is low, what does that do to price? When supply drops, but demand is still there, guess what? Prices go up. This is a cycle we see over and over again in commodities. And right now, this is the last 20 years of inflation-adjusted crude oil prices. We're definitely in a lower price part of the cycle right now. It's not insanely low. We've certainly seen lower, but even at these prices here, you have companies like Berry and Vital and many others who have double-digit free cash flow yields, sometimes over 20% free cash flow yields. Do you have any idea what would happen to the value of these companies if the price of oil simply went from 65, a low end of this range, to not even an insanely high historical oil price, just, up to $80-ish? Pretty much all of these small producers, many of these peers in this group, would be multi-baggers. Now, obviously, a big part of this thesis, the big elephant in this room, is oil supply and demand. So we have to talk about the oil market. Now, I'm not trying to argue that oil prices are going to go to, $100 a barrel, or we're going to hit $150 a barrel, or anything like that. I'm simply making the argument that oil is not going away anytime soon. Oil and natural gas are the majority of our energy. If you add coal to the conversation, hydrocarbons, this group, these three sources right here, they are 87% of global energy. Renewable energy sources are nowhere close to replacing hydrocarbons in terms of our energy consumption. I think it's a great thing that the world is investing in clean energy, but it's just a fact that you cannot have an energy grid running primarily on solar and wind right now. They aren't consistent, stable energy sources in the same way that, natural gas is. Nuclear probably would have the long-term potential to replace hydrocarbons here, but it's just so politically unpopular. No one in the West is really building nuclear reactors. The world's total energy consumption is going to go up and to the right. Energy consumption 10 years from now is going to be more than it is today. Energy consumption 20 years from now is going to be much more than that. And as much as I would like for the global energy consumption to be majority clean energy, that's just not going to be a reality for a very long time, probably much longer than people are forecasting. This was the EIA's projection not too long ago. We see they're forecasting renewables to grow quite significantly, but guess what? Petroleum and other liquids, they think that we are going to be consuming more of that in 2050 than we are today. Natural gas, we're going to be consuming more of that in 2050 than we are today. OPEC is projecting global oil demand won't peak until 2050. Now, in the Americas and Europe, they're thinking that it's going to peak sooner than that, probably 2030s. But the growth of demand in India, the rest of Southeast Asia, the Middle East is going to more than compensate for that. And the end result is that we are going to be consuming oil for a lot longer than a lot of people think. Now, one argument you sometimes hear against oil demand is, what about electric vehicles? Won't oil demand crash once you have tons of electric vehicles on the road? I think the answer probably is it won't make as big of a difference as people are forecasting. In the US, in spite of people driving hybrids and electric cars nowadays, we consume more gas per car today than we did 20 years ago. In Norway, they have adopted electric vehicles much faster than a lot of the rest of the world. Right now, electric and hybrid vehicles account for 23% of Norway's total fleet. That's quite high, but guess what's happened to fossil fuel consumption in Norway? It's been flat for a decade. If Norway's transition to EVs has made a difference in fossil fuel consumption, the difference is so small that you can't see it in this chart. In fact, I took this chart from an article titled EVs will have no effect on oil demand. Now, that's a bit of an extreme statement. I don't think I fully agree with it. But again, I'm not making the argument that oil prices are going to go to the moon. In today's pricing environment, the Berries and Vital Energies of the world have over 20% free cash flow yield. I'm making the argument that these companies are completely asymmetric investments today. Now, getting back to the oil market, it's my general thesis that oil demand is going to go up. And in fact, I would say that's probably a consensus view. There's disagreement about when oil demand will peak. I think we're decades away from that. But the other side of the coin is probably where there's even more fear. The other side from demand is supply. Commodities like oil have very volatile prices because a little bit of extra marginal supply can really move the price. And to give you a quick overview of where global oil supply comes from, this chart is showing oil production by country over time. I think a lot of people aren't aware that the US is far and away the largest oil producer in the world today. We're followed by Russia and Saudi Arabia, Canada, Iraq, UAE, Kuwait, Norway. But really the vast majority of oil supply growth over the past decade has been coming from the US. We used to just drill a hole into the ground, you hit some oil reserve down below, the pressure pushes the oil up that shaft, and bam, you have an oil well, you have oil coming out of the ground. Well, we were running out of these conventional oil sites to drill, and this boom in production came from us figuring out how to get oil out of these shale rock formations. This is shale rock right here. You see you have all these little layers of the rock, and deep down in the earth you have oil called tight oil, which is trapped between these layers of shale rock. Drilling a hole just straight into the ground wasn't going to work, so what we figured out how to do, we drilled a hole in the ground, we used water and pressure to fracture this rock, and then instead of drilling just straight down, we would turn the drill head and we would drill horizontally. This allowed us to drill, right through these oil reservoirs that are between these shale rock formations. And while this has led to an incredible growth in US production, just zooming in on the most recent few years, we are likely reaching the peak in shale oil in the US. Trump has said, drill, baby, drill. He wants the US to increase oil production. He wants oil prices to be low. But you know what? It really doesn't matter what Trump thinks. Just geologically and with oil prices where they are, US oil production is probably about to turn negative year over year. Not counting COVID, this is something that we have not contended with in over a decade. So the main source of supply growth is going away. I think some people aren't fully taking this into account. The consensus narrative right now, the mainstream point of view is oil supply is going to overwhelm demand. There's just going to be a glut of oil. And yes, it's true, OPEC has announced significant production increases. OPEC is a group of countries. It stands for oil and petroleum exporting countries. OPEC Plus adds 10 other countries. The biggest one in terms of oil production is certainly Russia. I'm not going to get into the full history of this, but a few years ago, a group of 8 of these countries voluntarily cut their oil production to support oil prices. Now, this group of 8 is rolling back those cuts. So there's a concern that, supply is going to go up from these 8 countries. In terms of their stated quotas, supply is increasing by, 2.5 million barrels a day. That's quite a lot of oil. In actuality, I think it's likely that the real increase is going to be less because some of these countries, some of the group of 8, notably Iraq and Kazakhstan, they were already cheating on their quotas before. They were already overproducing oil. So now that the quota is higher, they don't have any more room to increase production. Most of this supply increase, it's going to come from Saudi Arabia. So I think these supply increases might not be as much as the consensus thinks. And I don't see much evidence looking at the numbers that supply is just totally overwhelming demand. One thing analysts look at just to see, what is the balance of supply and demand looking like is they look at inventory levels. If crude oil inventories are going up, it means, hey, we're producing a lot of crude oil and it's not being consumed. Supply is outpacing demand. And similarly, if we are drawing on inventories, if inventories are decreasing, if they're low, it's a sign that, supply is not keeping up with demand. And despite the narrative that we are going to have so much supply, that is not what we're seeing in the numbers today. US crude oil inventories are down. If we break this out, whether we're looking at crude oil or distillate, inventories are low. Gasoline is maybe closer to the middle part of its normal range. But basically, we're not seeing evidence in the numbers that supply is massively outpacing demand. The EIA publishes a weekly report on change in inventories, and guess what? We drew down 6 million barrels of crude oil this week. The top comment on this is, we were promised an oil glut. All we got is fewer oil rigs running and a nice big weekly draw. The CEO of Saudi Aramco, which is Saudi Arabia's national oil company, said market fundamentals remain strong, and we anticipate oil demand in the second half of 2025 to be more than 2 million barrels per day higher than the first half. I think the negative sentiment around oil prices, and especially the negative sentiment around these oil companies, is a bit overblown. Also, another leading indicator of where supply is going to be in the future is how many oil wells are being drilled right now. What is the rig count in the US? And the rig count has basically been dropping for 3 years. Even in Saudi Arabia, rig counts are down. And yes, you can argue that today oil rigs are more advanced than they were, 10, 15 years ago. So you maybe don't need the same number of rigs for the same amount of drilling. But all in all, when I think about what's likely for the oil price going forward, I don't see any reason to think that we won't just have normal commodity cycles going forward. There's going to be periods of low prices, periods of high prices. I don't really have a doomsday view that oil prices are going to be low and remain low for just a very long period of time. So that's my thesis on oil. I want to start talking about some companies because I think that there is a massive amount of money to be made here. To just briefly mention natural gas, I think it's more of a consensus view that the future for natural gas looks fairly positive. There's going to be a ton of increasing power demand for all these AI data centers. We're already seeing that ramp up. The energy there is going to primarily come from natural gas. You also have LNG projects that are ramping up in Canada and the US. LNG stands for liquefied natural gas. And when you take natural gas and you liquefy it, you're able to ship it out to the rest of the world. Gas prices in parts of Asia and especially in Europe are insanely high. So the build out of these LNG projects is definitely bullish for the gas producers in the US and Canada. Now, getting into companies here, I'm not going to do a deep dive. I don't want this to be an insanely long video, but if you like this, subscribe to the channel. I'm happy to talk about some individual names, go in deeper on specific companies, and tell you why I think they're offering great opportunities. But keep in mind, none of this is a recommendation to buy or sell any of the companies that we are talking about here. There are risks, there are company-specific risks, and we're not doing a deep dive into them in this video. You have investors like Warren Buffett, who's been pretty aggressively buying Occidental Petroleum over the past few years. And while the bigger players like Oxy, like Devon, like CNQ in Canada, while a lot of these players look like they might be value today, I'm really looking at a basket of absolutely dirt cheap small producers. I'm just using Vital Energy as an example. There are additional risks to these small companies. I will almost certainly be wrong about some of them, so please do not take this as a recommendation to buy any of these. What I'm looking at when I'm looking at these smaller companies is, one, what do their reserves look like? How many barrels of oil equivalent do they have improved reserves on their land? And what percent of that is oil? What percent is natural gas? For Vital Energy, they have about 450 million barrels improved reserves. And the present value of that at say $70 oil is over $4 billion. Keep in mind that Vital Energy stock is when I started making this video, Vital Energy stock was trading for $14 and change. Today is Friday. I guess now we got a bump, but you know, these stocks are volatile. I mean, it's going to be up and down. When you watch this video, who knows, might be lower, might be higher. But if you're just taking a look at their market cap today, this is under a $600 million company. Now, keep in mind, they do have a significant amount of debt. So the enterprise value for this company is, around $3 billion. Again, this isn't a deep dive into Vital. The point being is the first thing I look for is what do their reserves look like? How does that relate to the value of the company? Also, on the subject of reserves, what percent of that is oil? We see for Vital Energy, it's a little under half oil. Over time, this probably will get gassier, meaning a higher and higher percentage is probably going to come from natural gas and also natural gas liquids. A second thing I want to look at is what is the cash flow of this company? Again, using Vital as an example, they're calling for about $300 million in free cash flow. Oil prices are down a bit since this report, so this number will likely be lower for the full year, but they actually have a lot of their production for this year hedged. 95% of expected second half 2025 oil production hedged at $69 per barrel. Basically, they already have contracts that are fixing the price that they're going to sell their future production at. So they're not as exposed to the volatility in oil prices as other companies, at least for this year. And again, comparing this number to their market cap, you are going to get an absolutely silly percentage. Again, market cap is roughly 600 million. And I guess I picked the right company in my basket of small producers to use as an example for this video because Vital's up 8% on the day. Now, getting back to analyzing these companies, a third thing I want to look at is how are they using their capital? A company that is trading for an absolutely dirt cheap valuation should not be looking to go out and make acquisitions. Vital's management has not been the greatest about this in the past, but they seem to have found the light. They're focusing on paying down debt, targeting net debt reduction of $310 million for this year. Again, that was at current prices when this report came out, so they might fall short. But regardless, they're basically using all of their free cash to pay down debt, and that is what I want this company to do. Fix your balance sheet, get your house in order. When your house is ordered, you can think about share repurchases. Don't go out and try to conquer the world when you are trading for a dirt cheap valuation. Speaking of the balance sheet, a fourth thing I want to look at is what does the debt look like? For Vital, this is a real risk. They have over $2 billion in debt. That really is a lot, but they don't have any maturities coming until 2029. So they have a lot of time here. I think for me, the risk is acceptable. Other people might disagree. That's just my opinion. A final thing I want to look at is what do their costs look like? Some companies are sitting on amazing assets. They can produce a barrel of oil for very cheap. Some companies, it's going to cost them more. You're going to have different break-even prices for different companies. And if you're buying low-cost producers, there's going to be less risk there. Now, Vital Energy, they are not a low-cost producer. Their average break-even, they're looking at, 52 in the Midland Basin, in Delaware Basin, $55 a barrel. But recently, costs have been coming down. They've been improving efficiency. They're getting their break-even price down closer to 50. The risk with buying a higher cost producer is, can the oil price go below $50 a barrel? Yes, certainly. It's definitely possible. Would that be a problem for Vital Energy? Yeah, if it's down there for an extended period of time, that would be a problem for Vital Energy. I wouldn't bet my portfolio on this, but these are the things that I'm considering, that I'm taking into account when I'm deciding, is this good risk reward? And I think I'll wrap up this video here. If you want to see me do a deep dive into Vital Energy, or if you want to see me go into other small oil producers, do an overview of where I think the opportunities are in this sector, subscribe to the channel. Let me know your thoughts down in the comments below. If you don't want to invest in this, that's fine. I'm not trying to convince anyone to make any investment. I'm just giving you my opinion, telling you what I'm doing with my money. I do have a portion of my portfolio in a basket of these small producers. I think they're deep value today. And let's just see where Vital is before we close the video. Vital is up 10%, 11% almost on the day. So thank you all for watching, and I hope to see you in another video.